Good morning, everyone, and welcome to the Infinex Innovate Fall Summit. For those of you who I have not met in the audience, my name is Scott Davis, and I am the Chief Relationship Officer here at Infinex. And I want to thank all of you out there in the audience for joining us today. I know you have busy schedules, and we really appreciate you taking the time to join us this morning. Also, I want to thank our sponsors. Without them, we clearly couldn't put on these conferences. And I have said this at the beginning of each one of these virtual meetings that we put on, that I really appreciate both everything that you've done as advisors and our partners in the audience to pivot in this environment, as well as, our product sponsors who, again, pivoted in this environment to help us deliver our services and support our clients in the field. So thank you to both all of you out there out there in the field for all the work you've done over the last year and a half to make us so successful, and to our sponsors. I also want to say a special thank you to the Infinex team for putting on these conferences. This is the second one we've done this year, and I think we did 6 of them last year. Special thanks to Amy and Ida Viglione and all our regional managers for all the work they've done to put together the program that they have in the past, and also for this week. So speaking of this week, we have a packed schedule of different sessions. We have about 26 different sessions, and really focusing on the idea that we will hopefully give you 2 or 3 or 4 ideas that will help drive your business as we go into the fourth quarter of this year and into the beginning of next year. Some of the sessions that we have this week include mastering the client review, something that we've all done a lot more of in the last year and a half. We've done it in a different environment, and I think you'll find that session very helpful as you try to master that part of your business. Finding growth solutions for near retirees. That session, as many of our advisors have told us, you're faced with the challenges of trying to help clients reach their retirement goals as the time period shortens. So a really good session there. We have another session in accelerate your business growth with differentiated strategies. And again, I think you're going to see a theme here, looking for ways to support you as you try to drive your business forward in the remainder of this year and into next year, and differentiate yourself from other advisors out there. We have another session, elevate the client experience to stand apart. Again, looking at the client experience and looking for ways to help you stand apart as advisors. So those are just a quick cover of 4 of the sessions. I encourage you all to go in and take a close look at the link on the website to all the different sessions this week. We also do have a separate session for program managers. I believe that's tomorrow. So if you're a program manager, I really encourage you to join that session as well. And then for today, we have 2 sessions. One is getting started in the advisory business, and that's at 11:30. And again, that is the fastest growing part of our business today. And if you aren't growing that business or haven't started utilizing our tools related to the fee-based business, I encourage you to join that session. And then this afternoon at 2 o'clock, we have our Wealth Solutions session. And that's actually one of our most attended sessions. And so anyone that's doing fee-based business should join that session, as it's going to update you on all the different tools and things that our most successful advisors are doing out there with their fee-based business. So again, thank you to our sponsors. Thank you to the Infinex team for putting this all together. And thank all of you, our advisors, our program managers, and all of our partners for, a really great, successful year so far in 2021, and all the work that you put into to reinvent yourselves in the environment that we've all had to work in for the last year and a half. So with that, we do have our opening speaker today, and it is Jeffrey Sherman. And he is brought to us by our really good partners at Jackson National. And I want to say specifically a thank you to Steve Papa, Regional Vice President of Strategic Relationships at Jackson National. Steve works really closely with our team here, and really appreciate all the work that you do and have done with us, Steve, over the years. And the partnership with Jackson National. So with that, I want to introduce Jeff Sherman. Jeff is the Chief Investment Officer at DoubleLine, and Jeffrey oversees and administers DoubleLine's investment management subcommittee, coordinating and implementing policies and procedures across all the investment teams at DoubleLine. He also serves as lead portfolio manager for the multi-sector and derivative-based strategies. He is a member of DoubleLine's executive management and fixed income asset allocation committees. Jeff can be heard regularly on his podcast, The Sherman Show, where he interviews distinguished guests, giving listeners the opportunity to hear the insights that DoubleLine has on current issues. In 2018, Money Management Executive named Jeffrey Sherman as one of 10 fund managers to watch in the country. And they mentioned this in their yearly special report. Prior to joining DoubleLine in 2009, Jeff was a senior vice president at TCW, where he worked as a portfolio manager and quantitative analyst focused on fixed income and real asset portfolios. Jeff was a statistics and mathematics instructor at both the University of the Pacific and Florida State University. He taught quantitative methods for level 1 candidates in the CFA LA USC review program for many years. He holds a BS in applied mathematics from the University of the Pacific and an MS in financial engineering from the Claremont Graduate University. He is a CFA charter holder. So with that, I will turn it over to Jeff, and thank you very much.
All right, thanks for the intro. It's hard to sit here and listen to your one's own personal accolades. So thanks for making me sit through that. What I want to talk about today was kind of what I think are some of the most important topics in financial markets today. And I like to use acronyms and to really try to drive it home. And so I entitled this Dishing the Dirt. We're going to focus on debt. Obviously, there's a lot of debt out there. The concept of inflation, what's going on? Is it transitory? Does it have, long-lasting effects? The reflation concept, which is something that, we've seen since really the late spring of 2020. We've seen a reflation of asset prices, the economy start to recover. And so where are we at that cycle? And the most topical thing that comes out of the Fed as of late is the taper talk. So that's the acronym DIRT today. That's what we're going to be focusing on. So let me take you on a tour of the economic data to show you where we are today. And so if you look at what's happened over the course of the last, let's call it 7 or 8 years, you'll see that the global economy has been relatively stable. And what I mean by that is that real GDP growth has vacillated roughly around 3%. A low year was 2.9. The aberration was about 3.7 back in 2018. And you can see that last year was obviously a bit of a calamity with the global pandemic, where the global economy contracted for the first time since the global financial crisis. But if you notice, the 2021 estimates in the purple line up top are going to more than make up for that contraction we saw last year. And so it'll put us back, albeit a little off of trend growth, it does put us back on positive footing. So things are looking up. But if you look at the economic data, and what this chart does is it distills it down by regions across the globe. And what this metric looks at is if you aggregate or amalgamate all of the economic data and you compare the current readings to their last 1 year average, where are we? And so when the number is negative, that means it's below average of where you've been for the last year. If it's positive, then it's above average. And you can kind of distill and identify trends here. And what you see here is obviously everybody got hit pretty hard back in 2020. That means that you get that reflation concept, you get a strong outperformance. But notice what you've seen as of late in the last 6 months or so. So that momentum is fading. So the black line is the US, for instance. This is the talk about peak growth. I want to remind everyone, when you hear peak growth, they're talking about peak growth rates, not that the economy is going to stall and not grow again. But this is consistent with a lot of those talks that you see out there. The US has been above average for a while here during the reflation concept. The trend looks like it's decelerating back to that average, but I want to remind everyone that that average is a very strong experience. Further down, you can see that China is a little bit below average. Remember, their credit impulses, they've been tightening their economy a little bit. We think that that remains underway for the next quarter. And then likely next year, as they get into their next plenary plan, you'll start to see that credit impulse, them try, as Xi Jinping would love to have another term as the kind of ruler for life, as the joke is. But notice what you also see, that the global economy is doing very well. And where you're seeing that is that the emerging markets, ex-China, as well as the Eurozone, are really delivering above average experience. So I want to focus on this chart because there's so much talk about the waning growth rate or the deceleration of growth rates. But remember, it's still a positive growth rate. So here's another slide that reinforces that. There's a lot of data on here. The point of this is just look at the color coding, where we were mired in a manufacturing contraction about 16 months ago. Everything is really performing in the developed world. See how strong those green shadings are. That just shows the strength of the manufacturing data. These are done by regions across the globe. So you can look at it and say, well, Indonesia is suffering, Mexico is in a little bit of a contraction. But in general, this is still a very positive attribute. And as vaccines continue to get rolled out to the emerging space, we expect some of those to pick up. So this is still, the reflation concept is somewhat intact here, especially from the economic front. And so where does this put us on trend line growth? And so I like to look post-World War II era. So you can see here, this is the real GDP growth. It's done in a logarithmic scale. So that way you can look at the slope of the line, which shows you how the growth rate is. And you can see here that, post GFC, you can see that dip down, that recession back really started to drive what we see as this change in growth rate. So if you look at the slope of the line since the global financial crisis, you'll see that slope has diminished a little bit. And that diminishing slope just says that the growth rate is lower. Now you can see here that we are ticking back up. The shaded blue area are the forecasts. We are above kind of where we were previously. And if you actually drew that trend line in, we're expected to be back to kind of trend line growth very shortly, probably within the next couple of quarters. Now that trend line that I'm talking about is the post-GFC one, not that long-term trend. So this is where some folks have brought in the concept of a potential stagflationary environment. However, I think potential for the long-term kind of growth rate is in the low 2% in the US. And that's really just what we've seen in the post-GFC era. However, I do think in the short term, we're going to see a couple of strong years. And so there's just another way of looking at it, drawdown. This just shows you the impact of how difficult the pandemic was. Look at a typical recession, post World War II, you had a contraction of maybe 1%, possibly 2% in GDP, but these last two recessions have been really powerful, right? In the GFC, it was a 4% contraction. Last year was about an 11% contraction. This is cumulatively, not in annualized numbers, but we have recovered from this. So not shockingly, why you've seen these response mechanisms be so strong in the past year or so is because this truly was something that was unprecedented in the drawdown, really in the last 100+ years. And then when you pull these things together, you pull together GDP growth and you put together the inflation, because that's really how the beans are counted when you talk about the economy, because it does include the inflationary component. And if you look at the forecast for 2021, now this is not real growth rates, right? This is nominal. So it's the real growth rate plus the inflation rate, what you see here is that we're on par to have, or on pace, I should say, to have the strongest nominal GDP growth we've seen since the early 80s. And that is quite impressive and no slight feat. Even look at what the recovery was back in 2010 and 11. You were talking roughly a 4% nominal GDP growth. So again, there was a big contraction here last year. But what you're finding is that you're going to put some of the most, the strongest economic numbers we've seen in many people's careers. And then if you actually look at the nominal GDP trend growth line, and this is, again, just going back to the late 80s, you can see that really we're forecasting to get that nominal GDP growth back to that trend line. So again, this is done in nominal dollars. It's also done in a linear scale, so that's why you have the exponential function there. But all that being said is that it does look like we're back on trend for this kind of last 30 plus years of growth rate. So it looks like, you know, the challenges were behind us. It doesn't mean we're not without challenges going forward, but we have made very strong strides. And so one thing that we were using during the pandemic to think about, you know, what is the impact on GDP was a data series that the New York Fed puts out that measures weekly economic activity. So it's an index that if you take a look at it, it aggregates a bunch of statistics to come out to figure out kind of where that economic strength is. And it's got a decent relationship. And you can see here that it gave us the signal earlier in this year that GDP was going to go ahead and spike back upwards. You've seen that. You can see this is waning a little bit, but if you believe kind of the forecastability of this thing, it says that, you know, you're still talking about GDP growth that's probably in the 4 to 7% range. And again, this is kind of a noisy series just because of all the distortion of the data that we've seen. But this is not saying that GDP is going to go into recessionary territory. So all in all, I think a lot of the stories about peak growth, it should be focused on rates, not the idea that the economy itself is peak. And if you look at the response mechanism, just, you know, this is, looking at kind of the G20 or so, the major countries around the world and how much fiscal support they gave to their own individual markets. And for all of the criticism of the U.S. that put about 26% of its GDP through its fiscal stimulus programs, you can see that it was not the largest as a function of their overall economy. Even things like Germany, Italy, that's a debt-laden society, the Japanese, we all know the story there. They tackled this crisis significantly deeper with the fiscal response mechanism. So, this is a thing that the developed world really did the same. You can see France is in a similar level as us, but everybody went big when it came to the fiscal response as a percentage of their overall economy. And to put this in perspective, what you can look at is the response mechanism of the fiscal authorities, what they did in 2020 versus the way they responded back in the global financial crisis. And so that blue line is just looking at how much debt accelerated post-financial crisis. You can see it took about 3/4 of a year to really start putting that big impact in the economy. So this time they wasted no time getting the CARES Act together and really driving this. You can see here on a cumulative basis that the debt has exploded during this area. But again, it was the response, how fast it was, how quick it was, and there was this really strong behavior over the last 18 months or so. So if you notice here too, we've kind of flatlined in terms of the change in the public debt outstanding. Part of that is the growth rate, with GDP being back up. But in general, this was a go big moment for the fiscal authorities. And another way to think about it is look at dollars. But again, you can see the dollars, massive amounts put into the system. So the response was big. It was something that was really unprecedented, and it was very quick from the fiscal authorities. And so what does that do? That gave us a very large budget deficit. And so if you go back into the post-World War II era, and this is just really from the 70s on, what you see here is that typically the deficit expands during a recession. You start to grow, you grow your way out of it, and the deficit tends to be either narrowed or when you invent the internet, you get a surplus. But notice what happened back in this last cycle, that we were expanding our deficit going into the recession. And so this was something that was in the last administration. There was significant amount of deficit spending even in the good times. And so when the recession hit, massive response mechanism. We got down to the point where it was roughly 18% of GDP at one point in time. You can see that improvement there. One is we've issued less debt as of late. I know a lot of people don't believe that, but we've actually issued less debt in the second and third quarters than we had, as well as the expanding economy, which has really benefited this. So in general, it's a very, very large deficit. We still have not worked that off. And if you take a look at it, you can see here that each recession seems to get worse and worse with this response mechanism. So no wonder people are thinking there's a dependency on the Fed and or Congress to really bail out whenever there is some recessionary behavior. So another thing that's interesting, if you look at how much of the spending was covered by taxes, we got to the point last year where there was actually, for every dollar that came in tax receipts, there was at least $2 of spending. So federal tax receipts got down to where they were less than half of the actual spending of the budget. So the joke I made last year at some point is like, why do we even pay taxes at all if we're not even going to come close to doing that? Now you can see here with some of this recovery, you've seen an increase in tax receipts. There's more people being employed. Also, just from the standpoint of property taxes, rising asset prices and some capital gains have driven some of this. So, 58% isn't great that that's what the taxes cover, but it kind of makes you scratch your head and wonder what's going on from a tax receipt perspective. And we talked about the fiscal authorities, how well they came in. That increased money supply, so something we call M2 in the economics world. But what you can see here, going back to the post-World War II era, once again, is that money velocity, the amount of money we pumped into the system was truly unprecedented. In fact, it was twice as much that had ever been circulated on a year-over-year basis. So this is an increase in kind of percentage of the money supply. So this is why people were fearful of inflation. This is why, devaluation of currency. We'll address all this as we go through. But the reason that I believe you haven't seen significant amounts of inflation is that money supply can't be analyzed in a vacuum. You also have to look at how that money turns over, or what we call velocity. And you can see that the velocity dissipated massively with that money supply. So money came into the system, but it wasn't turning over at the same rate it was pre-pandemic. In fact, it's been more at these levels. And you can say, well, how is that? Well, think about the banking system, right? There was a lot of government stimulus. And so even feeding things into the banking system, that there wasn't an increase in massive lending from the banking institute. So the banking system has ended up piling into treasuries, T-bills, they use the repo facility with the Fed. And so what that's done is that even though you have the supply of money out there, it's not really turning over. And so you would need to see velocity pick up here to really drive that level of inflation. So this is obviously something heavily on our minds. We focus on these data prints all the time. Again, velocity is a little bit stale because it comes from the government quarterly data, but it is something to keep your eye on. And so what you see is that where we are now with Fed policy, it's not just thinking about where interest rates are. We know they are quite low, but you can also think about it as the real interest rate. So you can subtract inflation. And if you just take the most recent inflation print, subtract that from where Fed funds rate is, it's about 7 or 8 basis points. Even though it's 0 to 25, it's where it trades. That's the effective rate. And you can see here that you have a minus 516 basis points. So one of the lowest effective rates that we've seen on a real basis. No wonder it's stimulative to the economy, because essentially the front of the curve is borrowing with this massive negative rate. So there is incentive to take on debt at this point. The only time that the print's been worse was roughly a month ago when CPI was slightly higher. So again, if taking the history in the post-World War II era here, once again, you see that rates have never been more accommodative on the front end, at least in purchasing power terms. And so inflation seems to be kind of ubiquitous today. It turns out that it is also everywhere that you see, whether it's the developed world, the emerging world. So one thing I find interesting about this chart, if you look at the dark blue line, that is the developed world. The light blue line is the emerging world. And actually right now is one of the few times where the developed world is generating a higher rate of inflation than the emerging world. Some of that is fiscal response. Some of that is also just the slowdown of the emerging economies, is that they've been delayed in terms of receiving the vaccinations, for instance. They were also a little bit delayed in having some of the outbreaks as well. So they haven't really hit full stride in terms of recovery. I think they're on the precipice of that. It may be 6 to 9 months away before that really takes off. But that's something you're seeing in the data too. So the developed world has more inflation today than necessarily what you see in the emerging market space. And again, that's not something you've seen over the last 10 years. And then moving along to inputs to inflation. So that's looking backwards. One thing that's a good lead on thinking about inflation is producer price indices. And so with the PPI, these are the input costs. So when you're looking at this, this tells you what it costs for the final demand to produce goods So when that happens, that tends to lead to inflation, because if you have higher input costs, it leads to higher costs on final product, which leads to a little bit more of inflationary behavior. And so why I show this chart today is not just the idea that producer prices on a year-over-year basis, that blue line, is as high as it's been in the last decade or so, but also notice those green bars. This is not something that's just a base effect. The green and red bars are the month-over-month changes, right? And you can see here that this clustering, this magnitude of producer prices increases is something that we haven't really seen in the last decade or so. So you got some little spikes above, you would get like a 30, 40, 50 basis points and then would roll over. Right now, you're seeing this persistent level, and a lot of this is supply chain driven, as well as some of the constraints we see within the commodity space. So I don't believe that this wanes anytime soon. I think that the cure for high prices are high prices, and so that's going to take a little bit of time to work itself through. Anecdotally, try to buy a big ticket item, try to buy a washing machine, try to buy a refrigerator, try to buy a vehicle. Things are constrained in the channels right now, and you see this with port backups. We have all this data you can support that shows that this is not resolving itself in the next 6 to 9 months. And investors had really started to look at inflation. So this is what we call a Google trend search. What it does is it just indexes to the highest level. So it's 100, that's the highest over the entire time period. And when it's 0, that means there's zero interest in there at all. And you can see here that the interest in inflation really picked up when you started to see these large prints back in May of this year. And so this is when we start to see inflation hit a 5% rate on a trailing year-over-year basis in CPI. But notice the other time that it was this high was post-global financial crisis, when people were talking about quantitative easing and the potential for the effects of debasing the currency and the inflationary effects. So it's a very similar kind of response mechanism here. That dotted line is incomplete data over the rest of the month of September. So we'll see if that dotted line plays out and interest significantly wanes. But definitely talking to advisors, talking to our clients, inflation is where we spend most of our time. So looking at measures of inflation, there's all kinds of different ways to look at it. There's different baskets. There's the Fed that uses core PCE. There's CPI, which is what most of us think about, the consumer price index. There's all these other metrics that have other ways of balancing out really just the contribution of the individual components within the basket. And every measure is reading above 2. The two measures that we focus on, CPI and the Fed on PCE, are the two highest measures you see here. So, definitely the Fed has a problem of trying to explain away that this concept is transitory for the time being. And so you can dig under the hood a little bit. What is driving inflation? So two big ways of segmenting the economy are into goods and then services. So goods are the things you consume, that they're gone. Services are things like experiences, right? So I think of that as dining out or hotel or anything that you need to kind of live your life that's not a core good. But notice what's happened during the pandemic. Goods inflation really showed up. And that is the thing that continues to be there. That is the whole idea of the supply chain problem leaking through and the PPI data being strong there. But last year when this was happening, when goods inflation was coming, service inflation was down. So there was this kind of handoff here between the two. But you've seen this resurgence this year back in services as the economy opened back up. People were pent up. They did want to go places over spring and summer. And what you found is that goods still stayed elevated. So this is what could put some pressure on CPI for the next 12 to 18 months as you think the supply chain, that goods inflation stays somewhat elevated. potentially not at 7.7% per annum, but even dissipating down to 4% or so would still have some pressure on that area. And also remember that the housing market inside of CPI is showing a year-over-year growth rate when you think about rent and owner's equivalent rent of about 2.6 or 2.7%. And that's completely inconsistent with, the 20% house gains we've seen in asset prices, but also on the rent side, which is coming in between 8 to 9% per annum. So there's a lot of pressure on CPI over that kind of medium term-ish. And so I think it's going to be hard pressed for the Fed to continue to use the phrase transitory, which is why you've heard Jay Powell come back and say that they've achieved their inflation target. But what's up with the bond market? The bond market, isn't really pricing in a long duration of this inflationary behavior. And so if you look at the break-even spreads, which is the difference between owning TIPS and owning nominals, this essentially is an implied inflation rate from the bond market. And the bond market's pricing 5-year inflation at 2.5%, 10-year at 2.33%, and 30-year at 2.2%. So the bond market is saying that, potentially we have inflation, but it is not something that's going to persist at least over the next 5 years. So you start to scratch your head and say, well, what does the bond market know? Well, one thing you have to remember is that there was a heavy footprint in the TIPS market where the Fed started owning roughly a quarter of that overall market. Right. And so if you look what you saw is that they owned about 8% of the TIPS market on their balance sheet, but now they own about 22%. So some of the signals you get from the break-even market, I believe, are distorted. It also makes me feel that TIPS are extremely overvalued. I see over the next 18 to 24 months, inflation running roughly between 3.25% to 3.75% per annum, which tells me that the bond market is extremely overvalued on these metrics. So some of that has to do with the Fed's footprint. I think you're not getting the signals that you used to get from the TIPS market. The data is strong. I think we all know that. Whether it's manufacturing, whether it's services, the U.S. is really firing right now. And so I know there's some challenges with labor. There's some shortages there. But in general, the data still continues to pull through quite strongly. So I don't buy this peak growth narrative, maybe a growth rate, and I can't emphasize that enough. The biggest challenge we have is still the labor market. Labor tends to, in a recession, you lose jobs. It's quick to cull staff, and then it is a slow grind to get them back. The U3 employment rate is the headline employment rate. The U6 includes the displaced or the underutilized workers, so the underemployed as well. In economics, they call it marginally attached. And so you can still see that there's high single digits of people who are unemployed and or kind of marginally attached to the economy, but we are making good improvements here. So I think as you heard from the chairman, he's been focused on the labor market. He didn't bring this up in his last two speeches, whether at Jackson Hole or the FOMC meeting a couple of weeks ago. But the labor market is something, the dynamic, that they're really focused on that blue line, not that red line as well. So we'll have to see what that looks like over time. But again, it is improving, but there is a fair amount of mismatch of skills with the jobs available. Another thing that was extremely helpful during the crisis was these extraordinary measures of using unemployment plans. So the blue line is the traditional unemployment plan. That's the regular state benefits that people get. There were these additional programs rolled out, specifically the PUA, which was not traditionally when people receive benefits, you have to have a full-time job. You have to have X number of weeks or months of employment. There's a bunch of criteria you have to meet. The PUA gave this to contractors, more people than normally saw that. And you see that there was a point where 15 million people were getting these extraordinary benefits that wouldn't traditionally be eligible. That red area, this is just the extension. When you file out of the state programs, the government would pick up some more months there. But these programs have primarily rolled off. And so if you look at the unemployment benefits, unemployment insurance benefits going into Labor Day, there's about 11.2 million people getting it. right? That 2.5 million are the traditional channels. Those are still existing. Notice that there's not a huge improvement there, but the PEUC and the PUA, a lot of those rolled out. So if this data was updated, you would see that there's about 5 million people cumulatively getting unemployment benefits today. So that's a big change in kind of the income streams of being subsidized to these benefits that hit the market in the month of September. So it'll be very curious to watch the consumption data in October as well as November to see if that does have some impact at the margin of the overall economy. So this is a moment that we've all been waiting for, knowing these programs are going to roll out. How can the economy stand on its own when a lot of people are losing some of these benefits? Again, that just likely brings more people in the labor force. There's a handoff between this, but it'll be very critical to watch. And so, again, I think what's interesting too is we showed you how GDP's grown, where we are on a real basis, where we are nominal, and we're doing this. We've got back to roughly almost trendline growth with 5.3 million fewer workers in the labor force. So it has been a little bit more of an efficient economy. Some of that is government spending, so that's related there. But you are seeing productivity actually increase. It did increase during the pandemic, which is kind of perverse to say, but we got a long way to go to get these jobs back, to at least get our labor force and just nominal people back to where we were. And so some of this is displacement with if you look at it, it's been a little more disproportionate to the older cohort who potentially retired earlier. You also see that there is a disproportionate amount of women that did not come back to the labor force relative to men, and some of it is minority driven as well. So you're going to see that this will take a little bit more time because it does take a fair amount of time to get those workers back there. But the picture continues to improve. And the income component, incomes went up during a recession. It's kind of a weird concept. Well, that's because the government stepped in. So that red line strips out all the government payments. And you can see here that incomes aren't really rising, at least relative to that trend. They're kind of back to where they were at 2019 levels. But the government stepped in and gave a lot of people a lot of money. And so, again, transfer receipts are the way you look at that. And you can see here that it's really unprecedented levels. What's pretty amazing is that even though 20% of personal income aggregate in the U.S. is made up of transfer receipts, notice what it was before the pandemic. It was like 16.5, 17%. And so why is that? Well, we have Social Security, Medicare, Medicaid. There's a lot of subsidies that are given out. So it's not it's not just something that jumped in the pandemic. The proportion of it did significantly, but it is something that, again, we have an aging society. This is something we'll have more dependency on over time. Wages are pretty stable. If I look at the blue line, if you look at the blue line over the last 6 or 7 years, you'll see that wages have been growing between 3 and 4%. The red line's a little bit noisier. It has a little more volatility. It was a little more depressed because it's average hourly earnings, and averages get distorted by extrema, and some of the extremas on the low end. So when the low end was disproportionately affected by the pandemic, wages shot up. It wasn't that there was all these raises going out, it was a composition mix. So as they come back, you'll see it gets distorted, so it bounces around. That's why I like the blue line. The blue line compares people's wages today to that same person where they were a year ago. So it deals with that control issue of the universe. So again, wages are here. If wages do break to the upside, get to 4.5%, 5%, I think that could drive a little bit more of the inflationary dynamic as well. Let me talk about the bond market. What does this mean? So if you look at what's happened on a year-to-date basis, this is a couple weeks old due to compliance, you'd see here that essentially the high-quality stuff is negative. Things that don't have a lot of interest rate sensitivity or are more credit economically exposed have done quite well this year. And you can see that from the high yield area, emerging market debt. You see it in the loan market in the U.S., and you see it in a lot of securitized products, as well as the S&P 500, massively dominating there. So in general, it's been a good year for credit. The key is to manage the interest rate component of the portfolio. That's something our team has been doing this year, having less exposure there. And this is even before the sell-off really started to take place in rates over the last week or so. One other thing that's really been set up here is that there's been this diminishing demand from foreign holders. The U.S. Holders have had to step in. This is ownership of the treasuries. But notice, too, that even as foreigners stepped out last year, the Fed is the one that kind of replaced that. But you have seen this increase in foreign treasury ownership in the last quarter and a half. And so it's been ticking up as the rate differentials were attractive, the currency differentials, the hedging costs were diminished as well because of the policy pass. And so in general, you've seen the biggest uptick in foreign holder demand you've seen in the last couple of years. And so I'm not going to argue that this trend necessarily reverses, but people ask, as the Fed starts to taper and buy less and less, remember, they're still going to hold those bonds, who picks up the slack? So the answer is it's got to be the orange or the blue line by definition, and we'll have to see how that plays out. Rates have been on the move lately. It sure doesn't feel like it when you look at these long-term charts here. These long-term just go back 3 years. But what you see here is that the front of the curve started to reprice a little bit. You sure can barely see that at 26 basis points on the 2-year in the upper left. The 5-year is the one that's really started to gain some momentum. So the 5-year trades a little bit above this today. We broke 1% last week. And I think that's a very, very important part because the 5-year prices a lot of credit assets, things like high yield, some of the securitized market. And so this is the part of the curve to watch because even though portfolio managers have a lower average duration, let's say a weighted average duration than the overall benchmark, a lot of them own credit on the short end of the curve. And so that credit has been accretive throughout the year. But if we get a reprice in the 5-year, it's something that I'm concerned about as well. So I don't really like 5s and out on the treasury curve today. Don't like 10s. You can see we have that pivot point where it bounced right off of that. If I look at the chart, it looks like we're going to try to push back to 175 on the 10-year. The long bond you see down there at 194, it bounced off that again. And we've been closing above 2 for the last week and a half. So in general, I think that those are the signals to watch. Watch the long bond. Does it stay above 2%? If so, I think we're going back to 250 on that. I think we retest the highs in the 10-year as well. Again, these are not huge rate moves, but on the long bond, for instance, because of the amount of duration it has, you could see the long bond being down, 7 to 10 points with that type of move. So it's there as a risk offset potentially. If you're an active trader or someone who tactically moves it around, I would be doing so today. Another signal we get from the markets that tell us about the path of the 10-year is something about thinking about the real economy using something like copper and then gold as kind of the risk off and risk averse asset. And so when you plot these two things, that the ratio of copper to gold, that's the blue line, you can see that it has a pretty good explanatory power until mid 2020 about the direction of interest rates. And in fact, it really tells you the direction. Should it be going up or should it be going down? So they don't necessarily need to overlap here. And what you saw here is that there was a disconnect in this directionality over really since the first quarter. And if you look at this gap, it says that the 10-year should be about 275 today. Now remember, I was talking about 175 on 10-year, not 275. And some of that's because of the Fed's footprint, how much they've been in the marketplace, how much they're buying per month. They're going to suppress rates a fair amount. And I think that premium is something about 75 to 100. So that's what I'm saying. A 175 to 2% 10-year still makes sense. On a fair value basis, the number should be closer to 3. And part of this was explained by essentially net issuance. And so for all the deficit we had over the last 18 months, Treasury's general account balance that they hold at the Fed was extremely elevated. And so there was about $1.8 trillion of just money parked at the Fed from Treasury that they drew down starting in the first quarter. And so we actually had a net negative supply of Treasuries. That is, the Fed was buying more Treasuries than were on average out there while this was getting shrunk in the market. So there's a technical reason for what transpired in the second quarter. Maybe potentially it had some Delta wave in it as well, slow down the economy. But in general, I think it was more supply and technically driven than necessarily a fundamental case. So again, it doesn't make me think that rates are going to retest those levels unless we got that type of setup again. And instead, we're talking about increasing the deficit. we're talking about the Fed buying less bonds. And so I just think a repeat of the second quarter is quite challenging today. So if you like credit, you can go to the investment grade market. Problem with that is that, the real yield is negative there as well. Even if you're looking at just looking at break even. So I'm not doing the trailing inflation rate. I'm taking the Barclays corporate index, looking at its yield, subtracting off the 10-year break even rate, right? So again, trying to marry up those tenors how the bond market's thinking, and you still have a negative 50 basis point yield there. So on a real basis, doesn't look attractive at all. Plus you have all that interest rate risk in there. So on an OAS basis, spreads are as tight as they've been. You can see here at about 84 basis points. We seem to hover between 80 and 90 basis points on the spread over the last few months. You can see here that it is kind of a post-GFC tight, while yields are tight as well. So this is my least favorite part of the credit markets. It just has too much interest rate risk in it as well. I'm not worried about the default environment. The default environment's benign, and the balance sheets are in good shape for the near term with no maturity walls. And so there's a reason that also high yield trades so tight in terms of its spread. Notice here that's not near the tights of 06 and 07. Some of that has to do with just all-in yields. You need to have something to compensate you for this at the end of the day. But also, what you see here is that a market that had refi that's been very active this year, and you don't have maturity walls for the next 18 to 24 months, that usually can be problematic. The maturity wall just means you have a bunch of debt maturing, and so it gets competitive out there to refi it because you got to pay it down through the refi way. So, spreads are tight here. Don't love this area. It is also exposed to that 5-year part of the curve. So you got to be careful when thinking about this. But what that means also, if we get a push up because the economy is doing better, you get a drive in yields, not just in the back end, but from the belly, let's call it the fives on, there could be some price action here to the downside, which makes an attractive opportunity to kind of reallocate towards some of these assets. So I'm neutral-ish on high yield. I like the idiosyncratic trades. I think a lot of the beta is very expensive today. I talked about how low the default rate environment is, just using the bank loan market. You can see here just a very, very strong performing market when it comes to that. That's my CLO strong as well. You can see they had significant drawdown last year. One of our favorite asset classes right now. I like loans as well. They give you some optionality if the Fed does pull forward their hiking plan. Remember, the market's price that they maybe hike for the first time by the end of 2022. If they pull that forward, the floating rate assets will benefit from that. So I don't think that's a base case. I still think they're in 2023 for hikes, but I do like the credit here, and it's pretty attractive part of the market today. Speaking of attractive, here's housing inventory. There seems to be a little bit more supply of homes come on the market, as there usually is during the summer months, but inventory is still extremely stretched. And that's what leads you to very strong house price performance. So this is very accretive for things like residential mortgage-backed securities, specifically ones that aren't guaranteed by the government. It's been a very, very stable asset class. Look, I do think that house prices do not continue at this trajectory. That's just given the performance of history, it's easy to say. But again, it would be healthy for some of these areas to slow down significantly, and it would be very, very healthy for some price corrections in certain areas. But I don't see that just coming. Remember, prices tend to be sticky to the downside. And so, even having low single-digit growth for the next few years would be very healthy for the overall housing market. Commercial real estate, the reports of its demise, I think, have been exaggerated. If you look at the prices of commercial property in aggregate, they continue to go up. And so even though there are still challenges in the retail sector, there are some issues with office space. Notice here that really the delinquency chart on the far right-hand side, the worst areas have been hotels. That delinquency rate is curing. That's the light blue line. The dark blue line is retail, which we all knew about, right, coming into this. But notice office space, there's hardly anyone delinquent. So even though there may be some restructuring over time of some of these contracts, you're still having folks like ourselves who are not using our office very frequently paying their leases. So overall, the health of this market is pretty strong. You've seen a recovery in the asset prices. This is still another area that we'd like to really overweight and overallocate capital to, because it has some headline risk in it. But if you do the credit work underneath it, there's some very attractive opportunities. This is all, these are the various ones by rating. If you get into the more credit sensitive assets, there's some very attractive opportunities here. Lastly, on the fixed income markets, emerging market debt, if you look here, the spreads are kind of roughly a little bit cheaper than average. You see that red line, that average line is a bit distorted by some of those spikes that we saw in GFC and the pandemic. So the 350 does feel more average to our emerging market debt team. And the fundamentals are starting to catch up. So in general, we're neutralish on EMD. We own it throughout all our portfolios that can own them. We're kind of at our average type of weights there, just because they're, it's kind of an average type of spread. And in a market that you've had some strength in the dollar and it's held in quite nicely. So there's a lot of accretive benefits here. And especially as we continue to push on, the biggest risk here would be a higher move in rates. And that's a problem for all of the global bond market. Lastly, the dollar, I mentioned it, the dollar bounced right nicely off these pivot points that you see on the chart, which was the high back in the high in the financial crisis was the low that's set here. And, and if you look at this chart too, you can see the upper bounds like that 102 area, 102, 103, and the low right there is about 88. So you're in a 15-point range over the strength of it. Even though the dollar has been strong this year, it's only up about 3 or 4%. So what's interesting to me about that is that you've had the strength in the economy, the strength in the recovery, was strength in the dollar without rates really moving a lot. So there's not a perfect relationship between rates and the dollar performance, but we definitely think the setup is there due to the budget deficits, the amount of supply of money out there, and just the lack of growth in part of the other world sets up for this next move to be down in the dollar, not up. And that's because of the recovery in the rest of the world. When Europe really starts to reopen, then that trickles over to the emerging market space. We think that gives the chance for the non-dollar assets to really perform. So lastly, I get asked about gold a lot too. One way to think about it is to real yields. If you invert the real yields, which is on the right-hand side, and this is looking about just what's implied in the TIPS market, you'll see here that the directionality has been pretty strong here. And there is a gap between these two charts as of late, which says gold should be a little bit higher. But also I think some of that has to do with, if you look at that blue line, when it really took off as the Fed started buying, TIPS last year, you can see that kind of caused a little bit of distortion between these two gaps. So I think maybe fair value is closer to 1,800 on this basis on gold versus necessarily, let's say, the 1,900 or so it implies. By the way, real yields have moved a little bit in the last week or so. So that number is about 90 basis points today on the TIPS versus the 100 it was a couple weeks ago when we did this. So all in all, I think gold is still something that has luster in there. It's been a little bit challenged. Remember, this is with the dollar strength. And so if you kind of think that that's going to reverse, gold does look like an attractive asset as well. So with that, let me turn it back to you for the Q&A if there's any questions that anybody has, and we can wrap up with our last 5 minutes. So thanks everyone for listening, and a shout out to my compliance team right there. So you can read this.
Well, as you could probably guess, we did have an anticipated question, which is, can you comment regarding the current admin infrastructure plan? If it's a go or no go, does that affect your forecast?
Yeah, I think we get something, whether it's, 3 trillion, 27 trillion, half a trillion, you're going to get something. And the problem with all these things is that they're sold as infrastructure. You look at the infrastructure, it's like a quarter of the package, right? It's complete pork and stuff. So I do think that you get something done through this process. I don't know what it looks like, but I think it's at the margin positive that something gets done versus kind of dismissing it being negative. But, look, the Dems have a big problem that they're centrist, just don't get down with the progressives, and they fight each other. They need to look at, if I had any advice to the Dems, it would be just look what the Republicans do, coalesce and just jam it through. So they don't do that, and, that they're going to have a problem. So I think it sits somewhere to the lower end of the estimates, not the upper end. But again, trying to predict Congress is like trying to predict the weather in a place like San Diego. It
So
looks
true.
easy, but you're still going to get hit. You're still going to get hit every once in a while. Yeah.
No kidding. Another question that came through is your thoughts on the preferred market.
Mm. Yeah, the preferred market is one we don't really trade too much, so I don't really have as much insight. I know there's been a deluge of debt out there. There's been a huge amount of issuance, and it's been very popular with advisors. So I know that because you get upside potentially with a high coupon. So I just don't have a strong opinion, but I know that from talking to clients, it's been a very popular area.
We'll ask one more while we have time. The question is, with dollar heading down, how much would you overweight international and where?
Yeah, I would start by doing it in the equity market, because remember, bond markets, although you can do the currency exposure, the currency's like 3 to 4x the volatility of the underlying asset. So I prefer to take that in the equity markets, right, where there can be some more pricing power too, and you can also benefit also from kind of international sales and the like. So I do think that you should start building those positions in both the European market as well as the emerging markets. And I think you should be, if your kind of target weight was, you want to be 30% of your overall portfolio of equities, then, you should be at least 20, 25, wait for that movement to really go deeper in there. But if you've benefited significantly from owning the U.S., the U.S. still looks attractive, but I do think that you should start tilting those direction. And again, you never want to be max early. You want to be max when the momentum comes. And so watch for the dollar to break down, watch to see what it does at this kind of 94 level on the DXY. And, let it get a little bit of momentum to the downside before you get to those max weights.
Awesome. Well, that's all we had time for questions today, Jeff. But
Okay.
Thank you so much.
Okay, well, thanks for having me, and hope everybody found there's something informative in there, even though it's a tough way to start your day with a bunch of macroeconomic data. So I appreciate it. Thanks for the support, and good luck to everybody.
Hey, thanks so much. And thank you so much, Jackson, for your support of our event. We appreciate it. And when your Jackson wholesaler calls you, I hope that you do pick up the phone. We do have another presentation starting at 11:30, so we hope to see you there. And thanks again, Jeff.
Thank you.
Okay, take care.
Bye-bye.
Bye-bye.